If you're a trader, you know the feeling. Staring at a chart, trying to figure out if you're looking at a real trend or just a bunch of random market noise. Well, today, we're going to build a complete framework to solve that problem, and it's all built around one of the most powerful tools out there, the exponential moving average, or EMA. By the time we're done, you'll know exactly how to use it to trade with way more confidence. So let's dive right in. The number one job for any trader is to find some kind of order in what looks like total chaos. So, picture this. You're looking at a chart and the price is bouncing all over the place. The big question is this a real move, a trend you can actually trade, or is it just meaningless static? Because let's be honest, getting that wrong is the absolute fastest way to lose money. We need a way to filter out all that noise. And that's where moving averages come into play. The idea is actually pretty simple. They just calculate the average price over a certain number of periods. By doing that, they smooth out all those wild, jerky price swings. It's like putting noise-canceling headphones on your chart, giving you a much clearer view of the real trend underneath. But, and this is a big but, not all moving averages are built the same. See, the most basic kind has a huge flaw, especially for active traders. It's just too slow. Yeah, I'm talking about the simple moving average, or SMA. The problem is that it gives the exact same weight to every single price in its calculation. So the price from 20 days ago is just as important as the price from yesterday. You can probably see why that's a problem. It creates this delay, this lag, that can make you miss the boat entirely in a fast market. And the solution to that lag problem is right here, the exponential moving average, the EMA. Now, its secret sauce is in the math. It's designed to give way more importance to the most recent prices. This makes it react so much faster to what the market is doing right now. And, as you can see, that means less lag and a tool that's just built for generating short-term trading signals. I love this analogy because it just clicks. Think of the SMA as a giant cruise ship. Yeah, it's stable and gives you a smooth ride, but man, it takes forever to change direction. The EMA, on the other hand, is a speedboat. It's quick, it's nimble, it lets you react instantly, but you're also going to feel every little wave of volatility. Okay, so we've got our speedboat, the EMA. Awesome. But just having a line on a chart isn't enough. How do we turn that into a clear, actionable signal to actually buy or sell? Well, the most popular way is by using something called a crossover. You know, if you just use one EMA, watching the price zigzag back and forth across it can still be pretty confusing. So a much cleaner, much clearer method is to use two EMAs on your chart. A fast one with a short period and a slow one with a longer period. And when that fast line crosses over the slow line, that's our signal. It points to a potential shift in momentum that's way more significant. Here's a perfect example, the classic 920 EMA strategy. So that blue line is our fast 9-period EMA, and the amber line is the slower 20-period. See right there, when the fast blue line shoots up and crosses above the slow amber one, boom, that's a clear visual buy signal. It's simple, it's effective, and it's a foundation for a ton of trading systems. Okay, let's level up. We can get even more confirmation by adding volume into the mix. This strategy pairs our fast 9 EMA with the VWAP. That's the volume-weighted average price. Now, because VWAP includes trading volume in its calculation, a crossover here isn't just about price anymore. It's a signal that's backed by some serious trading activity, which often means a much stronger move is coming. And why stop there? We can add a third layer of confirmation, a trend filter. This one uses 3 EMAs, a fast 9, a medium 21, and a slow 55. Here's how it works. That slow 55 EMA is basically our North Star. It tells us the long-term trend. We only even consider a buy signal when the fast 9 crosses the medium 21, and both of them are already trading above that slow 55. It's a fantastic filter to keep you trading with the current, not against it. Speaking of major trends, we have to talk about the two most famous crossover patterns in all of trading. I mean, these are the big ones. The signals that even long-term investors and the financial news pay very close attention to. I'm talking about the golden cross and the death cross. These typically use longer-term averages, like the 50-day and the 200-day. A golden cross is seen as a super powerful bullish signal, often hinting at the start of a major bull market. And the death cross, well, it's the exact opposite. It's a very bearish sign that can signal a big downturn is on the way. Because these happen on such long time frames, they carry a ton of weight. So crossovers sound pretty great, right? But they do have a weakness. In markets that are just chopping sideways with no real direction, they can give off a ton of false signals. It's called getting whipsawed, and it's incredibly frustrating. So how do the pros avoid this trap and boost their accuracy? This quote right here, this is absolutely crucial. You have to remember that EMAs are a support tool. They follow the price, they don't predict it. The raw price action, the candlesticks on your chart, that's what tells the real story of supply and demand. The EMAs are just there to help you confirm what the price is already telling you. And the absolute best way to put this all together is with multi-time frame analysis. The concept is actually really simple, but it's incredibly powerful. You use a high time frame chart, say a 4-hour or a daily, to figure out the main dominant trend. Then you zoom into a lower time frame, like a 30-minute chart, to find the absolute perfect moment to get into a trade that's already aligned with that bigger trend. Let's walk through it. Step 1. Go to your high time frame chart and get your bias. Are the bulls or the bears in control? Step 2. Be patient. You have to wait for the price to pull back a little bit. Step 3. Now you zoom in, go to your lower time frame chart, and watch that pullback happening up close. And step 4, this is your trigger. You only pull the trigger and enter the trade when the price action on that lower time frame shows you the pullback is over and the main big picture trend is kicking back in. That's your high probability entry right there. Okay, we have covered a lot, from what an EMA even is, all the way to advanced confirmation techniques. So now, let's put all the pieces together into a simple, structured framework you can actually use. It boils down to 3 simple steps. First, bias. Figure out the market's main direction using a really slow EMA or a high time frame. Second, signal. Now you wait for a crossover, like a 14 crossing a 50 EMA that lines up with your bias. And of course, traders use all sorts of combinations, like the popular 34 and 89 periods too. And third, entry. This is when you zoom into a lower time frame and wait for price action to give you that final green light. Bias, signal, entry. That is the core of the entire strategy. And that really brings us to the final and honestly the most important question. The framework itself is simple. The real challenge isn't understanding the lines on a chart, it's having the patience and the discipline to actually wait for all 3 of those pieces to line up perfectly before you click the button. That's what makes all the difference. So is your discipline strong enough? Thanks for joining me.